gone through a really interesting time over the last 3 months. We've had a lot to contend with, looking at geopolitical instability. We've been looking at how to contend with, the results of the war in Ukraine, the resulting energy sort of crisis that's developed out of that globally, its follow-on impact into inflation and the policy and rates response sort of globally. And then more recently around the UK financial stability has come into question as well. So it's been a really sort of interesting time. So I'm really pleased to say that, the positioning around the portfolio since we did the strategic review in 2020 was to create a more stable defensive portfolio, which we implemented, sort of over 2 years ago. So as we previously described, that was really around moving the portfolio to more private assets from its public form to be able to be more defensive around the income and defend the dividend. And we've done that in the context of reducing risk on the equity side, repositioning the portfolio, positioning for growth on the private side, and also taking some risk off the table when it comes to listed credit. So we've done a number of things in the portfolio. We're about 22% into equities and fixed income, and holding a bit of cash for sort of future opportunities. At the same time, we're about 55% into private markets. And the private markets have been broken into a broad range of income generation, inflation assets, as well as sort of growth that involves investments into infrastructure, real estate, private credit, private equity, and natural resources. So we've been really pleased with the performance of the trust in recent times, given the volatility and instability that I've just mentioned. So what really we've seen over the last couple of years is that the portfolio has been very stable from a NAV standpoint, and we've defended the dividend, delivering 5.6 pence per share. And so for I think the last 2 years, broadly speaking, we've delivered just over 10% for investors per annum in terms of return. Now, we haven't been immune in the last month to the market sell-off. We've had significant amount of volatility in the portfolio and in markets. And I'm pleased to say we've only our NAV has really only decreased by about 2% over the course of that period, up until September. So we were really looking at a very stable portfolio. Now, the share price has resulted in a sell-off in equities. We're not immune to that. And now our dividend yield being quite stable is around sort of 6.2%, which we think is a really attractive level of dividend kind of going forward for investors. There's been a number of key portfolio changes really to deal with the economic environment that we're in at the moment and looking at risk over the longer term. So what we've done is really in two parts. We've repositioned the portfolio from public to private, which has been a journey over the last couple of years, but it's really been sort of intra-asset class that we've done a fair bit of work in the medium term. Over the last 3 months, really, that's been focused around the equities basket, taking equity risk off the table in terms of the types of equities that were highly correlated to markets. That's reduced to about 9% of the portfolio. The rest of the equity exposure, around 22% in total, so the 15% that's in the other types of listed securities, are really focused on less economic sensitive parts of the market, like listed infrastructure and royalties. On the credit side, we've reduced the exposure to credit overall. That's now reduced down to about 20% of the portfolio. Within that, the intra credit baskets have been really de-risked to some extent. We've taken a fair bit of the junior and mezzanine positions out of the portfolio. We have exposure to emerging markets and frontier markets, which are markets beyond emerging markets, which have historically had a lot of high yield. But those have now come out of the portfolio completely. We have a much more reduced listed credit exposure to those emerging markets, and have replaced that with what we describe as more senior secured loans in the private market space, still delivering quite strong yield. So at the portfolio level, as you can imagine, that's been quite a lot of work that's been going on to ensure that the portfolio remains very stable from a NAV perspective, but also can generate the dividend. The other thing to note in terms of changes to the portfolio is that, as you can imagine, there's a lot of work going on at the macro level. So we've really strengthened the bench at AD here, and I'm pleased to announce that we've got 2 new members joining the team to replace Jennifer Murnell, who's leaving the business. And that's Heather Mackay, who's the head of global asset allocation, and she's joined by Simon Fox and her team, really strengthening the asset allocation and implementation around the liquid markets part of the portfolio. There's a there's a number of really interesting underlying investments in the AD portfolio. I'll bring two of them to life, both with very different sort of aspects. Talking about the income and inflation story and looking at defensive and protection of our income streams. There's a program that we won't call Aberdeen Global Investment Infrastructure Partners, and it's the second program in that space, looking at really investing in social infrastructure on a global basis. So that's schools, hospitals, transport assets, leisure assets. These are all highly sort of contracted, secure investments around the world. And there's two investments inside of those that have done particularly well. One of them, which is worth highlighting, is what we describe as the I-77 investment, which is a toll road investment in the US. And during COVID, whilst we were still generating revenue streams off those contractual cash flows, the traffic flows, as you can imagine, were much lower than expected. Now that that's rebounded post-COVID, the revenue expectations that we were hoping for have been exceeded, actually, as more people start traveling again, and that asset's been written up significantly. And we've generated over 27% return for the AGIP program to date. So that's a really exciting opportunity, and we're seeing more inflation-linked and growth in income from our infrastructure assets. On the other side of the equation, we've got growth assets and a program that really takes advantage of the market dislocations that we're seeing is what we call SOF, the Secondary Opportunities Fund in the private equity space. And that's really buying opportunistic baskets of private equity holdings that have been sold by holders of these types of investors at a discount because of their particular requirements around liquidity. And as we went through COVID, there was a number of investments that were sold in this fashion. And the SOF program has delivered approximately about 49% back to us since inception. So a phenomenal return over this period of dislocation in buying in private equity secondaries. There's a number of themes in the portfolio that are playing out in the long term, and those really haven't changed since the thesis was put together a couple of years ago. So we're really focusing on three main parts of, I guess, the global macro trends, which are technology and emerging and future business models, demography, what's happening in terms of demographic change around the world, and sustainability as we focus on the path to net zero. In terms of technology, we're delivering that directly through our investments in venture capital and growth equity, having invested in some of the top leading names in venture capital, such as Andreessen Horowitz, for example, that have IPO'd businesses like Roblox, the phenomenal gaming and coding platform, looking at Stripe, the payment system. And those have all been sort of parts of the portfolio. More recently, Figma, having been bought by Adobe, has been a sort of another great example of technology being played out in the portfolio. In terms of demography, that gets played directly and indirectly through our emerging markets allocation, through the bonds program, and actually more directly through our infrastructure program globally as we build schools, hospitals, energy generation facilities around the world. That's about changing needs in response to demographic change on a global basis. And sustainability is a key part of the portfolio as we look at all of our investments. As we go through the energy transition to net zero, that's more specifically being played through the renewable energy program, investing in solar, wind, next generation transport through our infrastructure program, both on the listed and unlisted side. So that's the kind of long-term trends. In a kind of more near-term perspective, market dislocation is really what we're going to be focused on over the next 12 months, and that'll result in us rotating the portfolio to more growth aspects as we find dislocation in markets and being able to take advantage of value in the near term.